Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Very few people, or a few people, talk about data with such uh, nuance as our guest today on Talking Point does. He's Amish Shah, head of equities at BofA Securities India, and joins us to talk about their opinion on what could be the stance for the rest of the year. As I read their note, which was released sometime early August, Amish and his team have said that they do not believe that there is a US recession coming anytime soon, and as a result of which they are constructive, if I can use that term, on levels front on the market, even though on the percentage terms it may not be very high. Amish, great having you. Thanks for taking the time out.
Thanks for the opportunity, Neeraj.
Not at all. The pleasure is ours. So, Amish, tell us, I remember a previous conversation wherein you had mentioned that there are earnings cuts which you believe will come about in FY24, which don't keep you very constructive on the market. And now I read a note on, I believe, the 8th of August, wherein you are saying what I just said, that no US recession is equal to some bit of higher levels for the markets. Tell us what's led to this.
Absolutely, Neeraj. So you're very right. In the beginning of August, our US economics team has changed the view, and it's a big change in the view, I would argue, from believing that US is likely to see a mild recession to now believing that US is likely to see no recession, and it's going to be a soft landing scenario. If you recollect during our cautious stance on Indian markets, the biggest worry that we had for Indian markets was the US economy. And I mean, I would argue that it continues to be so because US economy is still a little bit in a flux. As we all know, that a very high interest rate historically has led to accidents. And we must also remember that a large part of the US economy right now doing well is also on the back of a large fiscal stimulus that's going on. And in case if that fiscal stimulus were to be withdrawn, that brings us back to worries about US economic growth continuing so strong. So we will have to watch out for that as a risk. But as of now, you're right that all things being equal, assuming that the fiscal stimulus continues in the US, which it is at this point in time, the view is that the economic growth outcomes in the US is going to be much better. There is going to be no recession. And that takes away one of the key concerns that we had for the Indian markets that has made us more optimistic than we were earlier.
The crux of the note also seemed to be, Amish, that while 1,000 points or 1,200 points, whatever, may look large on this base, it's about 5-6%. So it's not the move over the course of the next 6 months or 12 months, as the case may be, is not necessarily about what will happen to the Nifty, but what could happen to individual pockets in a scenario like this.
Absolutely, Neeraj. So as you rightly said at the beginning, we are still of the view that earnings, even for Nifty companies, are lofty. And as a result, we still believe that earnings for consensus will continue to get cut. In fact, we are primarily more concerned about those sectors and stocks where large part of the earnings growth is only driven by margin expansion. Because even when we are saying that US is unlikely to be in a recession, please remember that recession means a negative GDP growth print. So we are not talking about a negative GDP growth print, but we are talking about the growth rate in the US decelerating. So for instance, in this calendar year, the expectation is for US to do 2.1% GDP growth. Next year, we are expecting it to be only 0.7% GDP growth. So it's still a deceleration of growth. And in that environment, earnings growth in India is also likely to come off, especially margin. It is wrong. In our view, it is going to be wrong to believe that all the commodity coming off is equal to margin expansion for companies. We think a part of these margins will have to be shared in order to continue to deliver the volume growth that the street is building in.
Got it. Okay. So how do you propose to your clients that they navigate the Indian markets in such a scenario? I know that BofA clients in the US have put in truckloads of money. There was a Bloomberg story which spoke about the kind of money that BofA clients in particular have put into to work in US equities. Are your clients comfortable doing that with the Indian piece as well when they talk to you and you advise them that this is your view?
So, Neeraj, by and large, the concern of foreign investors on India has only been valuations, over the last few months, and rightfully so. I would not argue that valuations in India is necessarily cheap. But the way we are advising is that at this point in time, the headline indexes are not likely to offer much return. It has to be bottom-up stock picking. And there we do believe that there are still pockets of opportunity. For instance, even within the Nifty, 1/3 of Nifty even today trades below the long-term averages. And not all of these are buys, because obviously some of these stocks may be in a cyclical down cycle, or there might be stock-specific issues why they deserve to be trading below the long-term averages. But at the same time, there are opportunities for stock picking within sectors, and particularly within individual bottom-up stock ideas. By and large, obviously small caps are visibly looking quite overstretched. That is one pocket which is our investors don't invest too much money in. But small cap as a category is looking definitely overstretched. Within mid cap space, I think it's a mixed bag. Large caps, I think there are definite pockets of opportunity.
Got it. No, so Amish, the reason actually I was asking you this because when one speaks to EPFR, for example, they speak about how India dedicated flows have come off quite significantly from what they were at the peak in the preceding 3 months, if you will. So I understand that your clients are not taking an India view and you're not giving them an India Nifty view per se, but more about specific pockets. But the question is only about the comfort of putting in money, even in specific themes, in a market which is looking richly valued. Are people comfortable doing that?
Absolutely, Neeraj. So there is no debate about the fact that corporate earnings in India, as well as the economic outlook in India, is quite robust, especially compared to the rest of the world. So that as a thought is now very well understood. As I argue that valuations obviously have kept investors away. Everybody wants a dip in order to accelerate their investments in India. But more specifically, I would say that in the recent times, markets have to adjust for the four concerns that we can visibly see, which is higher bond yields globally, and therefore therefore you have to weigh between whether bonds are attractive as compared to equity. You have higher crude, you have higher inflation because of erratic rains, and there's a potential of a China stimulus. So all of these four factors, in a way, is negative for EMs or Indian equities particularly, and so valuations will have to adjust to that. My point is that we don't think that the pullback in the market on the back of these factors is going to be meaningful enough, because none of these factors we think is going to have a bigger impact, or let's say the impact is going to be relatively insignificant, or the impact is going to be transitory. So rather than getting worried about these factors, we would look to add into any potential dip on the back of these factors.
Get your point. Now, Amish, I heard you say that I'm just trying to get a sense of where is your bent in terms of preference, because I heard you say that 1/3 of the Nifty is below long-term averages, but not everything is a buy there, obviously because they may be in a cyclical downturn. But is that the pond largely that you get comfort fishing in currently because of the valuation comfort, or are you comfortable betting on businesses which might be punchy in terms of valuations, but the growth numbers seem very buoyant?
Neeraj, it is a combination of both. So let me give you an example. Within the pockets where valuations are reasonable, it is financials, healthcare, and energy. Large part of the energy basket, we are not optimistic despite cheap valuations, and there are reasons we can discuss later. At the same time, valuations for anything to do with, let's say, the Capex cycle or the real estate cycle are already punchy. But we do think that these are cyclical sectors, and therefore looking at long-term averages do not make sense. These are sectors where you have to compare valuations in comparison to the previous upcycle valuations. So clearly, the upcycle valuations will be higher than the long-term averages, of course. As far as we think that the visibility of the cycle to continue is strong, even at higher valuations, we are buyers.
Okay, got it. So I'll probe that point a bit later. Let me probe first the three pockets that you mentioned, and we'll talk about energy, but I want to start off with financials. We were doing some bit of work on how financials have performed, let's say, since 2020, if you will. And a statistic which it missed my attention, maybe you would have obviously looked at it, is that very strangely, PSU banks as a basket of stocks has outperformed private banks materially. And even the ones which are considered the high quality or the highest quality private sector banks in the recent past have underperformed meaningfully. Now, when you are saying financials as a bucket for the rest of the year or for the next 12 months to 18 months, what side of financials do you like and why?
Neeraj, again, my answer is more bottom up. We are no longer in the camp of saying that only private banks will benefit or PSUs won't. We think that each of the banking or the NBFC companies now have some of their own nuances. Meaning, as we know that there are some banks where there is management change likely, and that is one of the headwinds at this point in time. Investors want more clarity on that. There is another large private bank which is going through the merger process. Investors want to wait out to see whether they are able to deliver on a much larger size. So the short point is that every bank now has a specific nuance that investors want to evaluate, for more clarity before they want to allocate more capital to them. So as of now, so for instance, we are positive on two large private banks, but we are more cautious on the other two. Similarly, we are within the top two PSU banks. We are bullish on one. We are not bullish on the other. Within the mid-sized banks, there are about three banks that we are positive, but we are not positive on the rest of the pack. So it's a very bottom-up driven market and a stock picking at this point in time.
Got it. Healthcare is a very wide bucket too. How are you guys looking at that?
So we are, we are dividing into a short-term opportunity and a long-term opportunity. So if you are somebody who cares about more about the 6 month view, we think that US generic-led stocks will continue to do well, because the visibility of FY24 earnings is quite strong on the back of the US pricing environment right now. But equally so, if you're a long-term investor, we do think that the capacities that went dormant during the price war environment, is most likely to come back. And at that point in time, the pricing environment may not look as great as it looks today. So if I were to start worrying about FY25 earnings and therefore the long-term view on the space, then we don't necessarily want to be in the US generic space. We are looking at companies which are diversifying into either specialty drugs or biosimilars or hospitals or who have a very strong pipeline of new launches, because that is going to provide more visibility for FY25 earnings and beyond.
Got it. Okay. And fair point, and thanks for bringing that long-term, short-term argument as well, because the street is completely enamored by the US generic companies thus far. So it's good to get that view as well. Try and keep an eye on the pricing erosion re-emerging at some point of time, or actually deepening. I believe the erosion has just recovered a little bit, but there is still erosion out there. Amish, the other question is on energy, and you mentioned that that is a peculiar one within the bucket of companies which are where you, I believe, are still constructive on, but with some conditions.
Absolutely. So Neeraj, look, there are upstream companies and there are downstream companies. Downstream is very tough in our view because even if the crude prices are moving up, the pump prices are not, and as a result, the visibility on their earnings, is not that robust. Even if, despite the fact that these stocks are cheap, as I mentioned in my earlier discussion, despite the valuations looking cheaper than long-term averages, this is not the space where the earnings visibility is high. So we want to stay away. Within the upstream space, we have seen time and again where the government tries to cap returns on the back of the tax that they have, which again does not give us very good visibility or comfort on earnings going forward. So as we discussed earlier, this is not a cheap market. And the only way where the stocks will continue to do well is where the visibility of earnings is quite strong, which is just an aspect that is missing within the energy pack by and large at this point in time. We may be positive on one or two stocks on a bottom-up basis, but by and large, it's a sector that we would look to avoid.
Got it. Amish, I want to bring forth a point that you mentioned somewhere midway through this conversation thus far, and which is on the Capex theme. Now, when one looks at the Capex beneficiaries, in the last 6 odd months, there has been a significant uptick both in valuation multiples, of course, accompanied by meaningful earnings growth in select companies as well. And I heard you mention about upcycle valuations that have happened in the previous cycle, and therefore you compare them not with historic long-term averages, but with those. So my question to you is, based on the earnings growth estimates that you may be factoring in for these companies and the relativity of the previous cycle valuations, how comfortable should investors be when they look at these businesses at the current point of time?
So Neeraj, I will first divide this argument into first the business momentum, and then I will tie it up with valuations.
Sure.
So as far as the business momentum goes, we are extremely bullish. Generally in India, Capex cycles are fairly long. They are about 10 years long. We think we are only in the beginning of the third year of the 10-year cycle. So there's a long runway to growth. The cycle in itself matters because historically we have seen that from a down cycle to an up cycle, generally for the sector as a whole, margins doubles, working capital at least halves, and as a result, you have a tripling of returns and a quadrupling of earnings growth and valuation multiples, right? So you basically have it's almost a sector that works like a multiplication factor of growing top line growth multiplied by the benefit of margin expansion, multiplied by working capital improvement. And as a result, there is an outsized improvement in returns and then commensurate increase in valuation ratios, right? Valuation multiples. So I think that as a dynamic from a business perspective, I'm pretty confident it will continue. Having said that, for certain stocks, valuations have already gone too rich. And as a result, over the last 3 months, we have been downgrading a few stocks. So a lot of the capital good MNCs is where we believe that even if I were to look at or build in the entire 10-year of earnings growth and then put an exit multiple, assuming that the cycle is getting over by FY30, even then the stocks now probably would offer only like 6-7% CAGR return, which is a return that you would probably make out of a 10-year government bond yield right now. So why take the risk of equity? So there are certain pockets, especially the capital good MNCs, which we think have now become too rich in terms of valuations, and we have downgraded them. But then there are still plenty of opportunities within the contractor space, within the other capital good space, within defense, within railways, as a sub-segment kind of themes, which we continue to stay bullish.
Awesome. One final question, Amish, and that is, it's a two-part question because I don't know which of these you would be, having the necessary this thing to answer. But we're seeing two interesting things in this Capex related thing. There are some very niche opportunities or Capex related announcements that are happening. There is a global watch major who is talking to a local manufacturer to set up a line. We were talking to a healthcare fund manager who was talking about how global healthcare majors are now telling Indian companies to set up a line of manufacturing because they don't want to do more with China and want to do a little bit more in India. And the same could be happening to chemical companies, as the companies have told us in their Q1 numbers as well. What is amongst this, what is that the most interesting thing that you've come across that you like personally from a long-term perspective in terms of announcements or a theme, so to say? And two, can this be chunky enough, or in a large market cap and a large economy like India, this is maybe just par for the course and maybe people are making too much of it?
So I'll start with the latter question. I think purely from a Capex perspective, China plus one, at least over the next 5 years, is not going to be a big needle mover. So even if we are so positive on the Capex cycle overall, the incremental growth coming from China plus one strategy for Capex is not going to be very large.
Okay.
And the reason for that in our mind is that most of the sectors that are seeing traction right now are all light manufacturing industries, which are not capital intensive. We are not going in for, or at least for the next 3 to 5 years, we are not likely to go for too much of heavy industries, which is more capital intensive. So Capex growth will come, but the China plus one or Make in India is not going to be a big contributor to that. Having said that, we do think that Make in India or China plus one as a theme is going to make a very big difference to the current account deficit of India over the next 5 years. That is where we will see a big needle move on the back of that theme.
Okay. So I'll wrap up the interview with that, Amish. From a market's appeal perspective to global investors, how big could this delta be, or the swing of the needle be, from a country which is traditionally, for the really long time or almost throughout its history, been a large current account deficit country, or a current account deficit country, now moving to near surplus, if not actual surplus, and it may differ from year to year, but almost at parity, so to say. How big an important thing is it for your investors, or for you, when you pitch the India story? Not pitch really, but when you talk about the India story to your clients?
So Neeraj, it's going to be quite significant. As per one estimate that we did, we think that if I were to take existing current account deficit and look at the current basket of goods and services that we import and export, and assuming that basket remains constant, obviously it will be a moving basket. But for simplicity for our calculation, if we were to assume that current basket remains constant, then we think that the current account deficit has come down by 73%, purely on the back of the Make in India or China plus one theme that we are talking about. And this is, by the way, taking conservative estimates, assuming only the sectors which has a very high visibility of performing. Only those sectors go through. So I'll give you a few examples. Within the import basket, we are assuming that consumer electronics imports comes down and its export starts to ramp up, which is very likely. We are assuming defense imports to come down. We are assuming coal imports to come down on the back of government having opened up, FDI as well as commercial mining for coal within India. So in short, the point I'm trying to make is that if you take only the high visibility sectors and you take the impact of what can be the likely contraction in imports and what could be the commensurate increase in exports out of these 4 or 5 sectors with good visibility, I think we reach to an outcome of 73%. If you have continuity of reforms and continuity of, let's say power sector reforms are in the offing, there is already a draft electricity law that is ready. If the government were to get re-elected, expectations are that will, power distribution is the next big reform that India will see. If these kind of reforms continue, then I would argue that more and more sectors will keep getting added to this story, and then the delta, could be even bigger than the 73% number that I argue right now.
Okay. Amish, thank you so much for your time and giving us a lowdown on what led to this stance that you've given and the nuances within that. Really appreciate your time today.
Absolutely. Our pleasure. Thank you, Neeraj.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.